Hi, welcome to this Acco Athena tutorial on finance and financial markets. We're going to talk about what is an index and we're going to explain market indices. So first of all, I'm sorry if you're going to hear construction noises in the background. They are still building a block of units about 50 meters away from where I'm sitting right now. So I've tried to wait till a quiet period, but I apologize if you can still hear it. Okay, so what are we going to cover today? First of all, we'll talk about what is an index, and then we'll move on to what do we use indices for. Indices just being the plural of index, and also indexes is also the plural of index. So there's a Latin version and an English version for the plural. So yeah, indices or indexes. Thirdly, we'll talk about the different types of indices in regards to price indices versus total return indices. Then we'll move on to 3B, the different types of indices according to their weights. Then 3C, the different types of indices according to their underlying securities. And finally, we'll talk about rebalancing and reconstitution. Alright, since this is a topic about possible investing and investment options, I just want to make this disclaimer. Please pause, have a read, take it on board, but generally, the business Acco Athena and myself, the individual, are not giving personal advice in this video. It's meant to provide factual information for educational purposes. I don't know your personal circumstances and financial goals, and thus this should be general information only and not taken as constituting professional advice. But please have a read. Okay, first up, what is an index? Well, literally, it's a numerical value. The output of an index is a numerical value like 20,000 or 2,000 or 660. It's just a number. This number is generated, published, and promoted by a private organization. So you might have Standard & Poor's, or MVIS, or MSCI, the Dow Jones Company. There's a number of them that promote these indexes. So this value I'm talking about is calculated from market prices of the index constituents. And the constituents are made up of a security market, an asset class, or a market segment. So what I'm trying to say here is an index can represent or reflect the value or performance of a particular security market, asset class, or market segment. For example, if the S&P 500 index rises 2%, then that represents a 2% increase or reflects a 2% increase on average and depends on the weightings of the 500 stocks that make up the S&P 500 equity index. Now there are tons and tons of indexes or indices. Here are some of the more common examples or more famous examples. We've got the Dow Jones Industrial Index, the Nikkei Stock Average, the FTSE 100, or the MSCI All Country World Index, that's like a global index, the Barclays Capital Global Aggregate Bond Index, which is a bond index, the FTSE EPRA, this one I haven't come across, so I hope I pronounce this right, the FTSE EPRA NAREIT or NAREIT Global Real Estate Index, which would be a property index, and the HFRX Global Hedge Fund Index, which would be an index of hedge funds. Okay, so what do we use indices for? So there are a number of use cases, and not just for one thing. The main reason is just to measure a market's return, or even measure the market or investor sentiment. Is the market going up? Is the market going down? Secondly, an index can be used as an investment performance benchmark. So you, as a personal investor, may want to set a benchmark of the S&P 500 and make sure your investments are above that benchmark. A fund manager or mutual fund may try to beat a particular performance benchmark, which is often set against a particular index. Thirdly, it can provide a model portfolio or a portfolio selection basket for mutual funds. Specifically, it could just be an index fund, which is an exact model portfolio, or it could be a large cap fund, where a particular index is organized by the size of the company, or the market cap of the company. And finally, it can also be used for quantitative functions. Indexes can assist in calculating beta, expected returns, and risk-adjusted returns. Alright, so now I'm going to move on to the different types of indices. Now the biggest difference, and where it's important to understand the distinction, is if an index is a price index or a total return index. Now a price index is calculated using the market prices of the underlying securities. Does that make sense? So It only looks at the market prices, so the price of a particular stock and so forth. So it only uses the prices of the particular securities underlying. Now, a total return index also uses the market prices, but also includes the cash flows from the constituent securities. So that can include dividends and interest. So a price index may have something like a stock moves up by 10% and the index would move up by 10%. But a total return index, if a stock's moved up by 10% and also paid a dividend, then the total return index would move beyond 10% to account for the dividends or interest within the securities underlying. Okay, different types of indices, weighting methods. Now, how each constituent security impacts the final index value is dependent on its weight in the index. So there's a number of different weighting methods that can be used for constructing an index, and we're going to go through some of the common weighting methods now. Now, there's the price weighted index, and I do have a formula for this, so I haven't provided it here because it's a bit messy and I didn't want to put it here. But if you want to get a hold of it, please comment or reach out, and I can post it in a reply. Might not be that neat, but at least I can do it in a text reply and outline the formula if you wanted to calculate some yourselves and so forth. Okay, so this is a price weighted index, and in this type of index, each security has an equal number of shares or units in the index. So perhaps if it was an index on the large companies of the US, they might have one share of Apple and one share of ExxonMobil. So there will be one share per each. And thus the higher price securities would have greater weight when all the shares or units are held equal. And this is why it's called a price weighted. So if you look back at that, again, this is a figurative example, not a literal example, but if one share of Apple was worth $100 and one share of ExxonMobil was worth $10, then if the price of Apple went up 5%, that would have a much greater impact on the index than if the price of ExxonMobil went up 5%, which would only be, I think, 50 cents, if I've done my sums correctly. Don't do maths when you're trying to talk into a microphone, Axel. That's an important lesson. Okay. Now, the second type of weighting method is a market cap weighted index. So I won't provide the formula here. Same process. If you want to get a hold of it, please comment, ask for it, and I can try and get it to you. Okay. Now, with a market cap weighted index, each security's index weight should represent the actual percentage of the total market value. So again, I'm using Apple. If Apple represented 30% of the total market, then there should be 30 shares or something equivalent. There should be enough shares to represent the proportion of the market. And as a comparison to that, if T-Mobile was worth 5% of the market, there will be 5 shares. So Apple here is 6 times the size of T-Mobile, and as a result has 6 times the shares in the index. And thus, the larger cap market securities have the greater weight. Hence, it's called a market cap weighted index. Now, third up, we have an equal weighted index. And you might be able to get this one from the name. This is where each security's index weight is the same. Each security should have an equal dollar value in the index. So this time we'll look at the prices. If Apple is priced at 50 and Netflix is priced at 25, then by definition, Netflix should have double the amount of shares in the index as Apple. So there'll be 10 shares of Apple if Apple was worth 50, and that would mean there will be 20 shares of Netflix. Now, if you do 20 times 25 and 10 times 50, you will see that both of those securities have the equal dollar value in the index. And in this type of index, this results in smaller market cap securities having a greater weight. For instance, we have the example there where there's 20 shares of Netflix. Netflix could rise by a smaller amount and impact the index more because there are a greater number of shares in it. And finally, this method means the index return is normally just the average return of its constituents. Alright, there are a few other weighting methods. This isn't a comprehensive list, and some of the other more common ones are there's float adjusted index weights, and you may have a market float weighted index or a free float weighted index, and that's where sometimes you don't include some securities because they're not freely available in the market to be purchased. And there's other fundamental index weights. You may have weightings according to revenue or earnings or even GDP weighted indexes. So for example, if you had a index that covered perhaps all the South American stock exchanges, you may weight them according to GDP. So perhaps Brazil and Argentina would have larger weights than perhaps a smaller South American country. And I do apologize for not knowing my GDPs of South American countries. I apologize if there's a very large country that I didn't mention, so apologies there. Okay, the third difference we're going to talk about in indices is the underlying securities. Now, there's virtually no restriction on the groups of underlying securities that make up the constituents of an index. You can make an index of whatever on earth you wanted, I think, but that doesn't necessarily make it a good index. The key idea is that it's not about restrictions on what can be an index or what's allowed as an index. It's about competition and relevance to make the index popular and adopted by the financial community. Do you remember I mentioned that they were promoted by private organizations? Unless an index is adopted, then it's kind of a waste of time, waste of money and energy. So importantly, to have mass adoption, an index must represent or include a material commonality or grouping useful for investors. They must be similar for a reason that investors consider valuable. So once it has that commonality or useful grouping, then it may become a popular and adopted index. So you could, like in theory, you could create an index about corporate bonds that had from companies that had headquarters with buildings larger than 10 floors. Right? There's no reason. I'm sure there will be a lot of corporate bonds that have company headquarters that have buildings that are larger than 10 floors. There'll be some that'll be less than 10 floors. But that's not material. That's not relevant. That's not useful to investors. You have to kind of find a grouping that people actually kind of see the reason why you would group them together and the commonality that is material. Alright, so here are the main types of groupings. So first of all, you can create equity market indexes. They're just your common and popular stock market indexes and the ones we most of all know. Now there can be broad market indexes, and that's the whole market. There can be multi-market indices, and that, for example, could be multiple countries. You could have sector indices, and for example, you could have technology, or you can even have particular style indices, and that means you might have like large cap or small cap or growth or value, those sorts of things. Now the second type of securities, you may have alternative asset indices, and here you may have real estate indexes, commodity indexes, or hedge fund indexes. Thirdly, you could have fixed income indices. These are your bonds. Now you may group your bond indexes by country or region. Again, you could use sectors. Thirdly, you could have the type of issuer. You might group them by corporate bonds or by government bonds. And you can even have bond indexes segmented by maturity. And finally, we're going to talk about rebalancing and reconstitution. The idea here is that an index is not a static and it's not constant in perpetuity. Indexes are frequently being updated, whether that's monthly or quarterly or annually. Now they can be updated through rebalancing, and this is where you update the weights of the index constituents. And the example here is that an equal weighted index, do you remember we described them earlier, needs rebalancing as the weights become unequal over time. So remember, an equal weighted index, you want to have them all weighted the same amount. Now they're all weighted the same amount on January 1st, and if one stock perhaps goes up for 3 months until the end of March by 10%, and another stock goes down by 20% until the end of March, and then the number of shares multiplied by the price would mean that the equal weightings wouldn't hold anymore. So you'd have to rebalance them and update the weights there and change the number of shares in the index so they all have the same dollar value amount again. So that's, just remember, the example isn't that important. The key idea is that rebalancing means updating the weights of the constituents. Secondly, there's reconstitution. This is where you update the constituents of the index. You can add them or delete them. The example here is the ASX 200, which is an Australian stock market index created by the S&P Group. This has companies that make up the top 200 largest market cap companies in the Australian Stock Exchange. So with that criteria, there could be companies that fall out of and rise into the top 200 market cap stocks of the ASX, and you would have to constantly update the ASX 200 to make sure that those in the list are the top 200 and those that aren't in the top 200 are out of the list. So perhaps quarterly or annually or semi-annually, they would perhaps delete some securities from that index and replace them with new ones. And whatever index that occurs to is called reconstitution. Okay, let's conclude and wrap up. What did we cover today? First of all, we just talked about what is an index. And an index reflects the value or performance of a particular security market, asset class, or segment. And what do we use indices for? And I mentioned they have a variety of use cases, but two of the most common are to measure returns or provide a performance benchmark for investment. Now, the different types of indices we spent a bit of time on. We covered price versus total return indices, the different weighting methods, and the different underlying security groupings. And then finally, we had a quick chat about rebalancing and reconstitution, which is that indexes are regularly updated to adjust their weights and account for changes in constituents. Okay, that's it. I hope it helped. Best of success. If you enjoyed the video, please share the video for your mates. Click the sharing widget that's probably on the platform that you're watching this on. I'm going out of my way to ask this. I didn't ask this previously, but try and share it. I'd be nervous if it went viral, but kind of excited at the same time. But yeah, please share it. I'd really appreciate that. You can always subscribe to the channel if you haven't already. You can click on the button that'll soon appear. Of course, you can watch another one of my tutorials right now, or even just give me a thumbs up. I'd really appreciate that. You can give me a thumbs down. I don't like that so much, but if that's what you got to do, that's what you got to do. The interaction is always good. And finally, please comment below if anything needs clarification, or if you just want to say hello. Yeah, and please comment below. Again, I'm asking this. Let's get a bit of interaction here. Try and stir up a discussion with me and all your peers. Yeah, we want to hear from you. So thank you very much for your time today, and I think that is it. Yes, it is.